Okay, good evening. Welcome. It is Tuesday, November 22nd, 2022. My name is Joe Kaiser. We are nearing the end of our Junior Achievement Personal Finance series. This week, we are talking investing. Literally my favorite topic when talking financial empowerment. I think it's the most important topic here. And I really hope you get something out of tonight. Okay. Let's press start. In this activity, you will learn about the difference between saving and investing, the advantages of and potential returns from investing, and common types of investment products. You will also learn about various types of investment risks. Before we begin, Ray, Arshawn, do you have any questions about investing?
No.
Not at the moment.
Okay. Okay, $1 million by retirement. Let's say you want to save $1 million by age 67. So FYI, age 67 is the current full retirement age for Social Security. What's Social Security?
You know, like your social media security, like passwords and stuff. Or wait, or no, maybe not.
No.
Oh wait, the current full retirement age for Social Security. My fault. I don't know.
Okay. So back in the 1930s in our country, the government established Social Security. Basically, senior citizens, people aged 65 and older, or 60 and older at the time, maybe even younger. Anyway, they were retiring or unable to continue working, and they were in poverty. They had no money. There was no monthly check coming. And so Social Security was established as a safety net. And traditionally, folks had to be of retirement age to receive Social Security. And so it's a set amount that we all get, in theory, when we retire. Now, a couple of things. We all pay into that. So when we work and we have a job and we pay taxes, or we receive income and we pay taxes, some of those taxes go towards Social Security. So if you've ever had a job with a W-2 or a pay stub, and you look at it, you'll see a line item that says Social Security. That's all about this program. That's all about retirement safety. So when it was established, when you reached age 60, you could start withdrawing your Social Security. Now, it was never designed to be someone's full retirement. Someone's full retirement was designed to be paired with like a pension or other savings. But in today's day and age, it has become the sole form of retirement for many people in our country. And then so what's been happening is you've probably heard this, or you will hear this as you go through your personal financial life. And as you know, as we'll say 18 to 20 some year olds, as you pay into Social Security, there is a legitimate question as to whether Social Security will be there for you when you retire. Does that make sense?
Yes.
Okay.
Yeah.
Okay. They keep raising the minimum age too. So you see 67 here. When I started working, it was 65. There's a chance it'll raise higher, you know, because when they raise that age, that allows the program to continue running longer. Okay. I didn't mean to get off on a tangent. There's a lot of content here, so I will try not to do that. Let's assume that you don't have any savings right now. Remember, you are 18 and we want to save $1 million. If you start saving $25 per week and earn an average 6% annual return on your investments, compounded annually, will you reach your goal? What do you think?
Can you say that one more time?
Sure. If you save $25 a week for from age 18 to age 67, and you earn 6% interest per year, will you have $1 million? Will that compound into $1 million?
This requires a lot of math. I think so though.
Think so?
Yeah.
Let's see what the
Because
survey
compound
said.
annually is once a year, and then I'm in the math class, and I know like the math to do this too. Like you got to change the 6% to 0.06 and all that. But yeah.
Yes. Yeah. Exactly. Exactly. Yeah. You know the compound interest formula.
Yeah.
The survey says here, no. If you save $25 each week, starting at age 18, and you earn an average of 6% on your return, you will have saved approximately $350,000 by age 67. So that's kind of an anticlimactic ending, right? No, if you save $25 per week, you won't get to $1 million. However, realistically, while you might start by saving $25 per week when you're 18, you should be able to save considerably more when you're 28, and considerably more when you're 38, and considerably more when you're 48. What do you think your prime earning years are? When do you expect to make the most money in your life?
Like what age?
Yeah.
Like probably your mid-20s.
Okay. Arshan, what do you think, Arshan?
I'll probably say 20s to 30s.
Okay. And why do you say 20s to 30s would be the time you make the most money in your life?
Because that's when you can work, and you're not like fragile, in terms of like being old and stuff. So like, you can work. You're in your prime basically.
I like it. Ray, do you say the same, or do you have anything to add?
Well, now I just rethought the question. I came up with a different answer, but I'm not sure. I'll actually say like probably your like teen age years, like 17, 18, 16, 17, 18, 19.
That's when you make the most money?
I think, because it's like, I don't know, maybe
Well,
not.
I don't want to be rude, but how old are you, Ray?
18.
Are you making a lot of money right now?
I mean, enough.
Do you expect to make more or less when you're 28?
More.
Yeah.
So yeah.
How about when you're 38?
Yeah, more. So yeah, never mind.
No, what I think the general consensus is most Americans reach their prime earning years between like 40 and 55, or 40 and 60. And those are the prime earning years because that's when theoretically you're making the highest salary of your life, or the most per hour if you're paid hourly of your life.
Well, you said 40 to 60?
Yes.
Okay.
Now, the exceptions would be, certain entrepreneurs, right? So there's plenty of stories of 20-something entrepreneurs, who crush it in their 20s and 30s, for sure, right? Athletes, right? The athletes are definitely going to make more money. Well, they're going to make more money per year in their 20s, but if they invest it, they'll make more money. They'll make a ton more money after they retire than during their playing time if they invest that money. But for the average American, Yeah, it's between age 40 and 60 that you're really making the most money, and you're really saving the most too. But the point of this slide is to tell you and encourage you to save, to start saving now as much as you can. If it's, you know, $25 a week, $25 a month, whatever. What's the difference between saving and investing? What do you think?
Saving is just your money getting put up. Investing is it can go, wait, money, more money is getting put in, right? Or can it go down?
Yeah, so that's
Yeah.
one of the differences. So there's a few differences between savings and investing, but one of the most important is when you save, you generally do that at a bank or a credit union, which is insured, and it can't go down. But when you invest, there's risk and it can go down. That's one of the differences. Any other differences? We'll learn about a couple of more. Some other differences between saving and investing are your intentions for that money. So when you set aside money for saving, Ray and Arshawn, you should have a goal in mind for that money. Like, I encourage you not to have just a savings account. I encourage you to have a savings account for something, and a savings account for something else, and an investment account. Okay, let's get into investing. What is an investment? An investment is something you put your money in to help it grow. So that's another major difference between saving, where you're really just trying to protect your money, and investing, where you're trying to grow your money. If you just keep your money in a piggy bank or a drawer, it won't earn any money for you. There are many different kinds of investments: savings accounts, bonds, and stocks. Each of these helps your money grow and works for you in different ways. Okay, savings accounts. When you put your money in a savings account, it's as though you're lending money to the bank. In return for letting the bank borrow your money, the bank puts you. Okay, instead of reading it, let me explain, how it happens. So if you have $100 and you put it in the bank with me, the bank will pay you, we'll say 1% interest for the privilege of letting us hold on to your money. So you'll get 1% of $100 in 1 year. So that's $1. Now, the business model of banks and credit unions, then some other customers of ours are going to need a loan. So like maybe Ray has the $1 that she wants to, or the 100 that she wants to save, and Arshawn wants to buy a car for that same $100, hypothetical. Instead of charging Arshawn 1%, which I'm paying to Ray, I'm going to charge Arshawn 5%. So I've got a profit there of 4%, right? And that's how a bank makes money. That's why a bank or a credit union doesn't pay you a ton of money to keep your money in a savings account, but it is better than keeping it in, like your sock drawer or a coffee can or at home. In addition to the security risks, like it being stolen or burning down, in a bank, you are going to earn interest and it's going to compound. I probably should have just read the paragraph. All right, bonds. When you buy a bond, you're lending your money to a bank, company, or government. Most of the time when you hear bond, you're lending your money to a company or a government who pays you interest in return for the privilege of borrowing your money. Bonds often pay higher interest rates than savings accounts, but you have to leave your money in them for a few years until they mature. Once the bond matures or grows up or ends, you get your initial money back, that's the principal, plus everything that the bond earned, which is the interest. So a savings account pays you a little bit of interest, but it's convenient because you can take it out and add to it whenever you want. A bond is still a pretty safe investment. Like, it's probably not going to go down, but you're locking that money up for a certain amount of time. You can't withdraw it. Stocks. When you buy a stock, you're buying part of a company, a share of a company. So let's say a company needs to raise money, for example, to expand production. It can sell shares of its company, which anyone can buy in the form of a stock. If the price of a stock goes up, the value of your stock goes up, and vice versa. Because stock prices go up and down every day, stocks are riskier than savings accounts and bonds. However, if you carefully choose the stocks you buy and hold them for a long time, you can typically make more money with stocks than with savings accounts and bonds. Does that make sense? Or what questions do you have about that?
That makes sense.
No, that makes sense.
All right. All right, good. You both are, Arshan, are you over 18?
Yeah.
You both may already own some stocks and bonds. Do you know if you do?
No, I don't know.
Like 4 months ago, I just put $5 in the crypto coin, so I guess, but
Okay. Okay. All right. Well, we'll see where crypto fits in here too. That's not part of it, but I'll fill it in for you. Okay. How we invest. So the purpose, so remember, the purpose of what you're saving for or investing for really matters, and that really drives your investment choice. So for a savings account, we put money in savings accounts for things we plan to buy in the near future, like a pair of rollerblades. It's always wise to keep some money set aside in a savings account for emergencies. So your savings account is money that is liquid. Remember, we talked about liquid. What does liquid mean? Do you remember what liquid means?
No, I don't remember.
Liquid means you can take it out whenever you want. So when you go to the bank, your money is liquid because you can always get that money back. Okay. Now, as we move up the chain here of investments and returns, they become less liquid. So we mentioned that bonds, you have to leave them in for a certain amount of time. That means you can't just say, I want my money right now. So that means it's not as liquid. So think about water flowing, liquid flowing. It doesn't flow very easily with bonds. So we typically invest in bonds to keep our money growing safely for something we might like to buy in a few years, like a car, maybe education, depending on how old our student is. But we can also use bonds to invest our money over a longer term. Stocks. We invest in stocks to grow our money for things we'll need far off in the future, like an education fund for our children, a house, or retirement. Okay, here's an important term, portfolio. A portfolio usually consists of a combination of these kinds of investments. So a portfolio is a combination. Have you ever heard the term portfolio?
Yeah.
Okay. Do you have a savings account, Arshan?
Yeah.
All right. Do you have a checking account?
Yeah.
Yeah. So your portfolio consists of a savings account with, XYZ amount of dollars in it, a checking account with XYZ amount of dollars in it, and some cryptocurrency with $5 in it. Okay. Other things in your portfolio might be a house. If you were to ever own a house, that would be in your portfolio, or bonds and stocks. So you don't need to invest all of your money in one or the other. Not only do you not need to, you shouldn't. So the whole point of a portfolio is being diversified. Have you heard that term, diversify?
Yeah.
So when we're saying diversify your investments, this is what we're talking about. So if you look at the portfolio, a diverse portfolio would have savings accounts, bonds, and stocks in it, and maybe some cryptocurrency, and maybe a house, maybe a business, maybe some real estate, some pieces of land. Most people have these three things in a house. This is where the term or the saying, don't keep all of your eggs in one basket, comes from. I mean, that's used for lots of things in life, but that's very applicable to this. And in fact, when you have a diverse portfolio, it helps offset some of the risk. So there could be times when stocks are just going really crazy and really strong. Like last year, they were up 30%. That's really good. It actually felt risky to have your money in savings accounts. Whereas this year, it's the exact opposite. Stocks have been horrible, and it's been safe to be in savings accounts and bonds. So if you have a diverse portfolio, you spread that risk out so that you can ideally smoothly make ever increasing money no matter what the market does. Okay, you may have seen this. If someone offered you $1 million today or 1 cent today, and then you double each day's new amount every day for a month, which would you choose? What do you think?
Wait, I gotta think.
I'm going to give you $1 million today, or I'm going to give you a penny today, and then for the next month,
1, 2, 4, 8, 16. I'll just take the million. I'm not gonna lie.
does convenience have something to do with your choice?
Yeah, because I stopped counting after 16 cents.
This is part, thank you for saying that, and thank you for your honesty. So this is part of financial empowerment, Arshawn and Ray. Part of financial empowerment, financial literacy, is understanding the power of compounding interest. So on the next pages, we're going to learn that taking the compounding interest is by far the better choice. So in other words, what I'm trying to say is the way to get ahead with your personal finances in life, or the way to not be taken advantage of, is to have a good understanding of the stuff we've been talking about. So here's a calendar, and you can see weeks 1 and weeks 2. Yeah, not super impressive, right? You get a penny on the first, then you get 2, 4. You were doing this in your head, right, Arshawn? 8, 16. By the end of 2 weeks, though, you're up to $82, which is kind of cool. Check out week 3. Week 3 is pretty insane. Ray, do you see what's going on here? So every day, you're doubling that amount.
Yeah, I see.
Yeah. Week 4. Week 4 is where you break $1 million. And then, so if you're going to go double, 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 you're going to be $1 million, $2 million, $4 million, $10 million.
But what if it's February? It's not- Nah, I see what
And
you
you're
mean.
stuck at 1.3 million. Yeah. So obviously your money's not going to double every day, but this is how it's going to compound. So imagine this calendar is 30 years of your life, and this is what your money's doing. It's really those last few years where it just goes, wow. Remember the Warren Buffett graph from a few weeks ago? No. Warren Buffett is a famous billionaire, super wealthy person. He made like 95% of his wealth like after age 60 because of compounding interest. The key ingredient to compounding interest is time. So the sooner you get started with this, the more powerful this effect will be for you. Okay, so let's talk about the concept of earning interest versus paying interest. Do you want to earn interest or do you want to pay interest?
Earn.
Earn, yes. If you're earning interest, that means you are lending the bank money. You are saving. If you're paying interest, that means you've taken out a loan from the bank. No, that's not all bad, you know, if you're buying a house, you know, or you need a car or something, but okay. Let's select the interest situation that earns the most money through interest. Is it 1, 2, 3, or 4? 1, Eric sets aside his pocket change at the end of each day to save up for a vacation. 2, he earns compound interest on his savings account, which he has set aside for a rainy day. 3, Jennifer pays compound interest on a few of her student loans. Or 4, Tony pays interest on his credit card balance. Which one earns the most money through interest? What do you think?
Eric.
Yeah. Which one of Eric's things?
The first.
How about the second?
Yeah, actually, yeah, the second. I'll have to reread it.
Yeah. So the first, when you set aside your pocket change, that's great. You're saving money, but you're not earning interest because you're just setting it probably presumably on a counter or in the jar or something. Whereas here, yeah, that's right. Eric is not only earning interest on his original deposit, he's also earning interest on his interest. Yeah. Interest is payment for the use of money, a fee paid to use someone else's money, or money earned from allowing someone else to use your money. So, you know, growing up, I always thought, you know, when you saved money, you just gave your money to a bank or a credit union and they paid you interest. That's true, but in reality, you're lending your money to that bank. And then when that comes due, your bank has to pay you back that plus interest. If you think of it like that, I think it's interesting. Kind of makes your savings, your personal life seem like a business, because it is. Compound interest is when the interest on an account is added back into the loan or deposit, making the original amount larger. So it's like that penny, right? You earned 100% interest every day, but because you doubled that every day, including the interest, you were earning interest on the interest, and that's how it doubled to $10 million, or compounded to 10 million. So in the scenarios before, compound interest is good news for Eric because it's money being paid to him on his deposits to his savings accounts, whereas compound interest is bad news for Jennifer and Tony because Jennifer is paying more money for her student loans and Tony is paying more money for his credit card balance. So that's the double-edged sword that is interest. The same interest that we earn can often be the same interest that we pay when we borrow money. That's why we have to be super smart with the money that we borrow. Okay, what is investing? Investing is putting money into a venture that offers the possibility of earning more money. All investments involve some degree of risk. In finance, risk is the degree of uncertainty or the potential for loss involved in an investment decision. The riskier an investment, the more likely it is to go up or down in value. Does that make sense? Why did you buy that cryptocurrency, Arshawn?
If you want me to be completely honest, I only bought it because me and my friends were just looking at it, and then we were like, all right, let's just put $5 in to see what happens. Because it was like going crazy on Twitter or something.
Yeah. Now, would you consider that a risky investment?
Yeah, it is a risky investment, I guess, because it's $5, but to me it wasn't really a big deal.
So you agree that it's risky
because it was financial loss, low-key, because I did go from $5 to like $3.
Yeah, and so it's risky because you do have the potential for loss. Like you could lose some or all of that $5. But it's also attractive. Like you do it in the first place because it offers the possibility of earning more money. Right?
Yeah.
Now you mitigated your risk by only investing a small amount. Right? So hopefully, for every $5 you invest in Bitcoin or whatever coin, you have 500 or 100 in a savings account somewhere. That's how you would like set up your portfolio. Okay. Let's read the description and then let's determine if it's saving or investing. What is the best option for setting aside money for a bigger purchase? Do you think it's saving or investing?
Saving.
Saving. Survey says. Yeah, I was like, how do you know? Yes, it is. Okay, yeah, best option for setting aside money for a bigger purchase, saving. Why is it not investing? Why didn't you pick investing?
Because you're just setting it aside.
Yeah.
You're not trying to let it like grow or anything.
Yeah, and so like it might be coming up kind of soon, and you don't want to lose it. What's your best option to plan for the long term, saving or investing?
Saving.
Survey says no. Well, they keep giving me the here. Investing. Long term is investing. If you see long term, it's investing.
Oh, okay.
Long term would be 10 years or more, I would say.
For sure.
Best option for growing earnings for the future.
Investing.
I agree. Best option for keeping earnings safe during emergency.
Saving.
So imagine your car needs a new tire, right? And you're keeping your money, your savings, your emergency savings is in Tesla stock, right?
Mhm.
That's not a good idea because you need that money whenever. You don't know when you're going to need it. That's the whole nature of an emergency, right?
Yeah.
But when you need it could be the very day that Tesla stock is down really bad, right? So that's not a wise place to keep that. And in addition, it's not as liquid because to get money out of a stock, you're going to have to go through several steps, depending on where you keep your money. If you keep it at like a TD Ameritrade or like on an app, it's still going to take a few days for that to show up as cash in your hand. So that's why you can't keep your emergency money in the stock market or a bond. Your emergency money should be liquid in a savings account. Money is generally not easily accessible. What do you think?
Investing.
Yeah, that's just what we talked about, right? Low risk. Saving, low risk, comes with the risk of loss. Investing. How's the stock market doing this year? Do you know? Do you care?
No, last time I heard about that was actually when I was at work and it was talking about it. So, but I wasn't like too into it.
Yeah. Where do you work at, Ray?
We're Radisson, so like we have like group of people come in.
That's right.
Yeah. So it was like an investment group and stuff, and they was talking about like stock marketing and stuff.
They were
So
probably encouraging you to put into your 401k, right?
yeah,
And did you?
no. No, I
How
didn't.
come?
I actually do not know because I'm just like now learning.
Hmm. Ray, if I can tell you anything, you please do that 401k at work.
Okay.
So when you invest in a 401k, that money goes into the stuff we've been talking about tonight. Like that's how you invest. That's the main way you invest. That's how I invest. That's how most Americans invest, is through their employer through a 401k. A 401k is just an account. It's an account at an investment broker, like a bank, kind of an investment bank. And they take that money for you that you invest every week. You pick a percentage. Try like 3%. You won't, I promise, Ray, you won't miss it. You might the first week, but then you won't. And then I bet the Radisson also even matches your 401k, right?
Probably.
Yeah. So like that, so what that means is if you put in 3%, say you make $100 a week, just because I'm bad at math. And so say you make $100 a week and you invest 3%, that means $3 is going to go into the stock market for you at age 18, right? And
Yeah.
then in
Like,
addition,
oh, sorry. Do you have to have like a bank and stuff to do that with?
no, 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 nope, you do not. So the Radisson in particular banks with Greenleaf Trust,
Mm-hmm.
which is a Kalamazoo-based investment bank. When you participate in the 401k, they establish an account for you. And so this money, this 3% or whatever you put in there, your hospitality group, the Radisson, matches that. It's usually 3%. That's why I mentioned 3%. So every dollar for dollar up to 3%. So if you put in my case, $3, they would match you 3. So you'd really be investing $6. So essentially, if you're not using your 401k, you're missing out on free money. and you're missing out on it at a time when you're so young. It's gonna be huge money by the time you're 65.
Oh, so I see what you're saying. Okay.
And Ray, that's like the whole point of tonight, like investing.
Okay. All right. So when I go back to work, I'm actually going to talk about that now.
Yeah. Go to your manager or HR and say,
Yeah.
hey, I really do want to sign up for that 401k.
Okay.
Ask how much they match. If you want, ask for the paperwork and then, give me a call. You can scan it to me. We can FaceTime about it. Like if you have questions about it, but
Okay.
you should really do that. And then, imagine you're not, say you didn't work at the Radisson until you retire. That's okay. Wherever your next job is, you take that with you.
Oh, okay.
So you're not committing to this. This is your money. And if you were then to go work at, I don't know, an architecture firm and you're going to be an architect or something, you just take that with you. And then you start working on it at your next job.
Okay.
If you're going to start your own business, you can add to it then yourself. You still take it with you no matter what. You can't access it until you're 65 or 67. That's kind of the catch.
Yeah. Okay. That makes sense.
Arshan, does that make sense? Do you have any questions about that?
No, that makes sense.
And if you are self-employed, or if your employer does not offer a 401k, all of us can still invest in an IRA, which is a type of account that's used for retirement that has the same tax advantages. Yeah. Okay. Grows very little, savings. Can help establish long-term wealth. Yeah. So Ray, when you are investing in your 401k, you are establishing long-term wealth. Money is generally unavailable for a longer period of time. That's investing. Low cost. What do you think is low cost?
Savings.
Yeah, I would say they're really both low cost, but access your money quickly, that's savings. All right, we get the point. Thank you. Okay. Yes, good. Okay, the risk versus reward trade-off. So all investments involve some degree of risk. In finance, risk is the degree of uncertainty or potential financial loss involved in an investment decision. So, am I going to get my money back if I invest in whatever this is? Not only am I going to get my money back, but is it going to grow as I hope it does? So, level one, start at the bottom. Level one. This is where you would put the most money. So imagine you're building a portfolio. Level one, almost no risk. However, little or no reward. Level two, low risk, but small returns as the reward. Level three, moderate risk, but potentially higher rates of return over a longer period of time. And then level four, high risk, but potentially high reward. One of the reasons, like the main advantage you two have over me, and I am 43 years old, over twice your age, is time. So the main advantage you have over me and all others older than you is time. And you can spend more time in level four with your money because if something were to happen in level four, you have time to recover. Does that make sense?
Yeah.
So generally, you want to invest your money in things that have higher risk when you are young, like your age, and then you smooth it out as you get older and closer to retirement. You know, because if you're 50, I'm not gonna say I'm almost 50, but like if you're 50, you can kind of see retirement. And if you had all your money in risky stocks and the stock market crashed when you're 55, that's not good, because you only have 5 years to take it to make it up. Now, Ray, if you start investing now and you invest for 5 years and the stock market, it goes up, 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 and then it crashes, in 5 years, you have another, 40 years for it to recover and keep growing. Hopefully that makes sense. As the level of risk increases, the potential reward increases, right? Entrepreneur, Arshan, I know you're interested in entrepreneurship. There's risk here, the same thing, risk and reward. What's the risk of being an entrepreneur and starting your own business? What do you think? What's a risk?
Just like any type of risk.
Of starting your own business.
I don't know. I guess investing a lot of your money into it.
Yeah, well, and it could fail. Like, people might not like it. So like, what if I started a clothing business and I put all of my money into it, and it just wasn't selling? Like, people just didn't buy what I was making. Right? That's risky. Now, it's potentially high reward though, because what if they did like it? What if they loved it? What if, like, I'm trying to think of a cool store. I don't know any cool stores. What if, like, a fancy store? What if Costco? Yeah. What if Costco loved your clothes so much that it wanted to buy millions of them? So there's like the potential high reward. Now, think about low risk and lower reward. So like, think about having a job like at a Fortune 500 company. There's little risk there, because once you're hired, you know that you're going to get a check, every week or every other week. So that's great. But I wouldn't say there's little reward, but it could be diminished, because you're never going to have the potential to earn, $1 million a year like you might as an entrepreneur. Does that make sense at all?
Yeah.
So the risk and the reward applies to investing, but it can also apply to many other things in life, like your career. Okay. Okay, explore each level to see examples of the type of investment. What do you think is a level 1? What's a level 1 type of investment?
No risk.
Yeah, what type of investment has no risk, but also little or no reward?
Well, like a savings.
Yeah, exactly. Cash and savings accounts, treasury bills, money market funds, or CDs. That's level 1. Almost no risk, but little or no return. So what do we think is the next one up?
Minor investments.
Maybe like bonds?
Yeah.
Yeah, bonds. So remember, bonds, when you purchase a bond or invest in a bond, you're giving a loan to a government, like a city bond or a school bond, like you've probably heard of school bonds or road bonds. You're loaning money, like if you buy a Kalamazoo public school bond, that happens all the time. Kalamazoo Public Schools needs to raise money for a new bus. They will sell bonds and agree to pay investors a certain return, but they're not going to pay it for a few years. That's the catch, if you will. All right, what's level 3? Is this stocks?
Oh yeah, level 2's bonds. This is stuff.
Oh, they separate stocks. So here, income real estate, so like rental apartments. It's like it's I don't want to say popular, but it's semi-popular, I guess, common-ish.
Yeah.
To own a rental apartment or some real estate. That's a level 3, moderate risk. The risks of owning a rental apartment, right, would be your tenants don't pay. Probably that's number 1. I think that's the main risk because you have insurance if things were to go wrong or burn down, but that would mean the tenants don't pay. And then they also say in level 3, conservative growth stocks and mutual funds. So I mentioned Tesla. I mentioned Tesla as not a conservative growth stock. What do you think a conservative company stock is? Can you think of an example? I'm going to mention like Apple. So like Apple or Amazon or Microsoft or Google. Those are examples of conservative companies that you know they're not going anywhere. Like those companies are here to stay, right?
Okay.
Nike. Pretty solid stock, right? Gerber, the baby food, Coca-Cola.
Okay.
Level 4. Oh, okay. Level 4, high risk, but potentially high reward. Things like collectibles, comic books, undeveloped real estate, precious metals and gems like diamonds, golds, aggressive growth stocks. So like stocks that are a little riskier, like a Tesla maybe. Tesla is actually probably more of a moderate risk. But yeah, why are metals and gems risky?
Yeah, that's a tough question.
Yeah, I had to mute because I didn't know what I was gonna say.
Yeah, well, and forgive me for asking it then, because yeah, it's weird. I don't own any metals or gems. I mean, most people don't. Well, I think most people don't own metals and gems unless like jewelry, but obviously it would be risky, right? If I had a big, if I had a bunch of bars of gold in my house and word got out about that, that's a risk, right? Like people would probably come try to take my metals and gems. But also, like, how do you get rid of metals and gems? Like, I don't know. That's interesting. Anyway, we went through them. Yeah. There we go. Here it is on a risk chart. Risk versus reward or return. So the lower the risk, the lower the reward or the return, the higher the risk, the higher potential return. Yeah. So what questions do you have about investing?
None. Thank you for teaching me about the 401k.
Ray, please, like, yeah, I don't care if you remember anything, please just invest in your 401k. That's the, yeah, that's the thing. As little as 3%. Yeah, and if I can be of any assistance, like helping you read the forms or helping you decide, you're going to have to decide what to invest in. And that's kind of intimidating, but they do offer, you kind of pick your retirement age. So like what year were you born in? Do you mind saying? Or
2004.
so if you go 2004 plus 65, like imagine you were going to retire in 65 years.
Mm-hmm.
You might, so Greenleaf Trust and most other investment brokerage